Hey guys, just wanted to do a market update for July. We had taken June off. And the last video we did was somewhere around the 23rd of May, I think. 23rd of May, somewhere around here. Crazy, crazy, crazy times, ladies and gentlemen. We were about 3 or 4% from the high in the NASDAQ. And as of right now, we're at new all-time highs, and I have the futures currently on the screen, so they're ticking up a little bit right now. Just kind of incredible what we're seeing. We haven't seen a run like this in tech in a very, very long time. This is getting beyond parabolic at this point. We're seeing this happen in 2020. So this is what happened in 2000, where we had this kind of like explosion up, grind up, explosion up. Well, I don't know what phase of that we're in right now, because just when you think this can't keep going, it just keeps going. Mainly the stocks that are leading this are Amazon, Shopify, Apple, Tesla, Microsoft, Zoom. Did I already do Zoom? Zoom. What's the other ones? Coop, Team, stupid things like Wayfair. My God. So you guys are kind of getting the gist of this right here. If you were to look at the S&P 500, it did not take out its February high. If you were to look at the Russell is the laggard of the indices, not even close to its February high. And the Dow, which nobody really cares about because it's only 30 stocks and nobody really should care about it, to be quite honest, is also not at the February high. I've been talking about this opportunity since I started doing these videos back in, I believe it was July, August of 2019, how the growth to value spread is just completely blown out. Let me see if I can pull that up. So this is from March, but we were talking about this back in 2019, and I was telling you guys that this is as wide as a spread as there has been since 2001, and then in March of 2020, near the bottom, near the low of March, we also had an extremely large spread. And if I were to, I can't pull that chart up because that is a Bloomberg terminal, which is more money than God. But it's something just as good. Oops. IWD minus IWF. So what this is, IWF minus IWD. So what this is I created a spread. So you're taking the IWF, which is the growth, Russell growth, that's 1,000 of the best growth companies out there, minus 1,000 of the best value companies out there. So it creates this spread. It doesn't look obviously like this, but you understand that the higher this goes, the wider the spread. So when we had talked about it back in 2019, we were somewhere around here. This black line that you see is the high of 2000. So the spread back in 2000 was at about 35 in the Russell 1000 growth minus the Russell 1000 value. Now we are at almost 3 times that. We're approaching 90. And so if you remember what I was saying and have been saying about sooner or later, the market is going to mean revert, meaning it's going to get back to something closer to this. So now the red is when value outperforms, the green is when growth outperforms. So we've been in a pretty strong period since 2015, 2016 of growth outperformance in a big, big way. I mean, what we just saw in Tesla today, Tesla went up 13.48% today. It added Ford's market cap to itself in one day. Pretty incredible. And in the aftermarket, it's up another 4.3%. So it's going to be approaching 1,400, 1,500 actually tomorrow. Unbelievable. And so what is unfortunate is I didn't tell anybody to jump on the growth train. Sorry. But generally speaking, I'm not a big crowd guy. So I know what happens when things like this occur, and you could go back to 2000 when Microsoft had its incredible run, when Microsoft in 1996 to 2000 went up about 10x, almost 11x, right? And then what happened after that is spent about 16 years in a bear market. So I'm not saying it's going to spend 16 years in a bear market under these prices. It could, it very well could. But I do believe at some point there's going to be a little bit of a mean reversion here. What's really interesting too, and we've talked about this in the last video, is that there was a plethora, I think that's a good word for it, a plethora? Yeah, let's go with plethora of new brokerage accounts that opened between the four brokerage houses. The four brokerage houses being like the TD Ameritrades, the E-Trades of the world, the Interactive Brokers, and I forget what the fourth one is. Whatever. So 12 point something million new accounts opened, and we had talked about this again in the last video. When the market had sold off 35%, people started jumping in. That's something that has never happened before. Normally, everybody rushes in near the highs of a market because they see the headlines every single day and they're like, oh my God, I got to get on board this train before it leaves. So what was really interesting this time around is that they had joined up in March, down 35%. What a great time to get in. Really a generational kind of opportunity. We've talked about how in 1987, that huge kind of market crash that occurred in 1987 gave everybody the opportunity to hop on for the roaring 90s. Well, you saw a similar, how often are you going to see a pandemic bring down the markets 35% in 2 weeks, in 3 weeks, actually. So it doesn't happen often, but it happened, and everybody was lucky enough. The retail trader actually won on this one, and they got in early. The other thing I want to talk to you about, in the last video, I was talking about, hey, what a really good thing would be is if we got some kind of sideways action, right? We were saying that, like, hey, the summer election year sideways action would be great. Now, I had said that somewhere around here-ish, right? 2 weeks, nothing but up after I said that, and then now went sideways. What's really interesting and what I think is going to occur, and I really do think maybe the next couple of weeks we're going to approach this high and maybe get close to taking it out, but we'll see. But we're very likely going to be taking out this 32, 33 area in the S&P 500. From there, I don't know if we're going to take out the high like the NASDAQ did. I don't think the Dow, the S&P 500, I don't think the Russell's going to make it happen. The reason is I think a lot of cash finally came off the sidelines. We've looked at this before in the past, and we've talked about how when cash gets into the 3.5%, 4% range here, kind of like between 3.5% and 4.5%, it means that the fund managers, and this is a global fund manager survey, the fund managers have decided to jump back in. Okay, so they decided to deploy the cash that they put on their books in March and April, and they decided to deploy it in May and June. So that's what you're seeing here in this chart, is you're seeing that they started to put money back into the market, hence this V-shaped rally that's occurred. This is pretty much one of the reasons that I believe that we're going to be cooling off for the rest of the summer. And again, it's an election year. The headline risk that's bound to come out between Biden and Trump at this point, going back and forth, who's going to win, what's going to happen when they win, whatever, right? if you remember 2016, everybody was scared to death, right? Like, oh my God, Trump's going to win, the market's going to crash. Well, the market did not crash. But even if Hillary had won, I believe this still would have occurred. It would have occurred a little differently. I think certain sectors would have led. Certain sectors under Hillary would have led. Certain sectors under Trump would have led. They would most likely be different from one another. And I think that same thing is going to occur here. It would be really, really good if we consolidated. It would be very scary if we didn't. If we did not consolidate from this move in the NASDAQ and it just kept going higher, pretty much the worse the bubble, the longer it takes to kind of rectify the bubble. And you saw in Microsoft that it took 16 years to rectify that bubble that had occurred in 2001. And I really hope that we don't get a market that just blows up to the upside and then kind of, comes down and never comes back until, we're in our 50s. So that's just something to consider. But when you look at the cash, as of right now, this is from June, so this is the most updated one. It's still above 4.5. We usually get pretty scared when it starts coming below 4.5 and gets into the fours. You want to run for the hills, generally speaking, when it's 3.5%. And the other thing as well, just like in 2019, and we had talked about this a lot, is that, look, they're still in cash, they're still in bonds. Tech, obviously, if they're not defensive, they're jumping in tech. So all the new brokerage accounts that had opened, all the new kids coming, all the new kids on the block are deciding to get into the names they know, and they are putting, everything they got into them, as you can see. So if you're not in cash, you're in tech, and energy materials are, like usual, down at the bottom here. Down at the bottom here just means that the fund managers are underweight, meaning they own less than their average portfolio allocation. So the value growth is interesting. This had popped up in June. This had never, I don't think I've ever seen the value versus growth before on here, but what that tells me is that they're starting to notice it. They're starting to notice this spread that has gotten completely out of whack. And that's a good thing that they're noticing it, because sooner or later, they're going to have to unload all their profits from tech and start dumping it somewhere else. And I believe that energy, materials, industrials, and any other value names like financials are a great place for them to go with it. We have looked at in the past, I'm not actually, I'm not sure. I may have showed you this once before, but so long US tech and growth. So what this is the most crowded trade of the month. And so again, this is from the Bank of America Global Fund Manager Survey. So all these fund managers get together, they all put in their 2 cents, and this is what pops out. So you had long US treasuries all of 2019, and we talked about that. If somebody is going to invest in US treasuries, you're playing defense. You're not playing offense. So everybody was in US treasuries in 2019. They were also heavily in cash in 2019, as you could see with this chart, right? So in 2019, cash levels stayed above 4.5% for the majority of the year, except for the last 2 or 3 months of the year, in which it just they started really putting their money to work. So most of 2019 above 4.5%, except for the last couple months. And then, so it was cash, it was US treasuries, and tech. So now the most crowded trade is going back and forth between long US tech and growth and long US treasuries. Why that's significant is that if they're still going to be playing defense and tech, if they're still playing defense and tech is, oh my God, Jesus, it's up a lot, and that's another nice bump in after hours. But if they're hiding out in tech and they're hiding out in defense, which is almost like oxymoron, but in this case it isn't, then at some point when this does revert, you're going to get the same effect as what happened in 2002 to 2007. And we've talked about this before, but I'm going to show it to you guys again here. We're going to get rid of those indicators. We're going to pop this into a line. We're going to pop it on weekly, and then we're going to compare it like I had showed you guys before. We're going to compare it to Mosaic. We're going to compare it to Manitowoc, and we're going to compare it to U.S. Steel. And the reason we do that is Mosaic is agriculture, Manitowoc is equipment, X is U.S. Steel. Those are all value plays. So if people are jumping into tech, that means they're most likely not jumping into value. If they're not jumping into value, this is what happens. So you can see, and now what it shows is on a percentage basis. So from wherever I start this chart, so in this case, let's say I started in April of 2014, all these value plays have lost between, say, 70 and 80 and 90%, while Microsoft is up 426% in that time frame. But the reason why this is significant is as I scroll back this chart here, you could see the roaring 90s, right? 1995 to 2000, Microsoft was up 1800%, just an incredible run. During that time period, value stocks just sideways, right? Not making a lot of headway. Manitowoc did all right, but I mean, look at that. Compared to Microsoft, not a big deal. But what happens is that reverted, okay? So you can see, and we're taking this from, say, 2000, July of 2000. From July of 2000 to 2007, look what led, right? So you have all the value plays going up 4, 5, 6, 700%, while Microsoft was down 12%. Now, obviously, Microsoft doesn't take the same hit that these value stocks do in bear cycles, but you get the point, right? Like we're at the point again where, I mean, let's see if I could do this from 08. Let's go right about there-ish. Actually, you know what? Let's do it from the bottom in 09. That'll be a better spot, somewhere around there. All right, so from the bottom in 09, Microsoft is up 11, almost 1,200%, while all these other stocks, the value plays, are down, right? So it's been and look, value had its run in 2011, had its run in 2014, stayed alive a little bit in 2018, but since then, even if I would have just switched this up, Microsoft just goes back far enough. But if I was just to do Shopify, let's see, there we go. If I was to do Shopify, you got that same effect. If I was to do something like a CRM, okay, CRM is in that boat as well. That's Salesforce.com. So you're starting to see here that, look, all of these software and tech names are the shiny objects of the market right now. And all the new traders and all the new investors don't want to go and do any kind of research to learn what the most valuable objects are. They just want the shiny object. And this is where they're going. And look, if you got in March to some of these stocks, you are doing absolutely incredible. You can't blame anybody for jumping in these things head first. This is Shopify from March. Just pick it from any point in March, up 185%. Go back to Microsoft since March, right? 52% since March. Let's look at the Apples of the world. Okay. 63% since March. So you do really well in these names if you bought them all on the dip. And they could keep going. A lot of them don't pay dividends. A lot of them aren't a good foundation to your portfolio with these prices. It's really tough to invest at highs. And especially when there's this kind of growth value dynamic going on where we are as stretched as we've ever been. Okay. We've never been this stretched in the history of the market. So, and there you go again, just to show you how crazy that is. So, okay, what are you going to do, right? So, maybe you want some exposure to some good stocks, but you want to stay away from, you want to stay away from these that are kind of blowing off right now. And the best way to do it, and I've showed this to you guys before, but recently I put together, I added one of the spreadsheets, which I will add to this email. But one of the best things to do is you just go to finviz.com and you select dividend yield, high, greater than 5%, IPO more than 20 years ago, which means it's a company that's been in business for a while. You could do 10 if you want it, but basically the most established businesses out there have been in business for 20 years. Price over 5, because I don't like dicking around with penny stocks. I used to when I was younger, but I no longer do. We want a profitable company, so PE ratio above 0, forward PE, so that means it's going to be profitable in the future. Price to book under 2, that means that if you were to liquidate all of its assets, minus out its liabilities, the market, it would be only 2 times higher than its current market cap, which is good. You don't want it, if it's under 1, it means it's extremely undervalued. If it's over 5, that means it's a little bit overvalued. And then you don't want a company that pays dividends, you don't want to have a lot of debt. It kind of creates, what's kind of the best way to say it? It creates like a moat around that dividend. You want to make sure that dividend is protected. You want to make sure they have good cash flow, that they have a good balance sheet. This is one of the easiest ways to do it. It's not a foolproof way to do it at all, but debt to equity is a great way to kind of ensure that the company that is paying you dividends isn't going to stop those dividends anytime soon. You could go under 0.6, under 0.5, under 1. I've always chosen 0.6. I feel like it's a good sweet spot for debt to equity. So what you're going to get is you're going to end up getting this page, but then this doesn't give you all the dividends. So what I want is I'm going to click on the financial page, and then I'm going to export it. When it exports, it's going to pop out something like this. And like I said, I'm going to be putting this into something really simple, okay? So I end up just copy and pasting, what did I do? 25? I did 25, the top 25 with the dividend yields. Now this is trailing 12-month dividend. The dividends, obviously, the percent yield changes every single day as the price goes up and down. However, it just kind of gives you a good idea of, what kind of yield you're going to get for your portfolio. So you can equal weight the whole thing. So 25 stocks, so it's going to be 4% all the way down. So if you were to just equal weight this portfolio, your annual yield is going to be 7.23%. So just make it real easy for you guys, okay? So $10,000, we're going to multiply that by, say, just 0.07. There it is. Do it by 0.070723. $723 a year for every 10,000 that you invest in this portfolio. Now that's if this is equal weight. So, that's not counting any appreciation that could occur in any of these stocks. Also, if you were just to change these to say, let's do the first 10 of them at 8%. So, and then we're going to do 10 at 8%. The rest is probably going to have to be somewhere around 1%, right? Something like that. Where am I at? 98. So we're going to do 2%, 2%. Okay. So you can, play around with this as much as you want, have as many positions as you want to have, but it's going to be able to give you your portfolio weighted dividend yield. Super simple formula, just the sum product formula to get the weighted value of a certain set of data. The other two things that are here is the standard deviation, which is volatility, beta, which is how well it tracks the S&P 500, which basically just says it tracks the indice, and then stock industry fund category. So when you export these things, depending on where you export it from, this is a nice little thing to have along with your portfolio on E-Trade or TD Ameritrade or wherever you have a portfolio. It's good to just have this and then maybe update it quarterly, maybe update it whenever, right? Just to keep an eye on it. And then another thing you can always do is you can extend these out and then add in like the percent return annually, annualized returns, just to get another feel for it. But you want to stay away from growth. You just really do. I mean, it's super shiny, it's super flashy, but there's so many good names out there. If I were to just go with profitable companies, price to book under 2, and we're going to get rid of this, okay? If we're going to just go with, actually, we want to have some kind of, so positive dividend yield. So you got 14 pages, 14 times 20 is what, like 280, something like that. So 280, so 280 stocks that you can take a look at. And again, if you do it financial, this is how it's going to break it down with the dividends. If you want to do it with the overview, you can do it by industry, do it by sector, which is, if just for diversification purposes, if you don't want to have like most of the ones on this sheet here are regional banks. Okay, so a lot of these, this is asset management, this is energy, but the majority of these on here are regional banks. So you want to create some diversification. You could just go here and then do it by sector or do it by industry, however you want to break it down, and then look at it this way. I like doing it. You just grab it by industry, then you go financial, and then you can kind of see it out that way too. So that's all I wanted to. I just wanted to give you guys a heads up. I'm sure you guys are seeing headlines out there that the market won't stop going up, but believe me when I say this, I think I have another kind of the best way to show you this is that it's really only 5 stocks, guys. It's like there's like 5 to 10 stocks that are carrying this whole entire market on its back. This AAI, I think I've showed you before. I mean, look, people aren't bullish. The people who do this survey since 1987, they're not bullish right now. That's normally a good thing. Normally in a steady uptrend, you want to see everybody be bearish. Then you play the contrarian and then you go bullish. Obviously the reverse case would be if bullish was well above 38%, which is the historical average, and bears were very low, then you flip it around, you get bearish. But we're seeing just a historical run. We're living through history right now with the way that growth is trading. It may not seem like it because the S&P 500 is just kind of going up little by little on a daily basis, but we are living through history. So I thought there was one more. Maybe I have it in my bookmarks. Maybe I could find it real quick for you guys. There's this chart that shows the market caps of, let's see. Nope, I'm not going to find it, am I? Probably not. It's too far back. Well, it just shows that like it's the Apples of the world, the Amazons, and the market cap of those companies, and the weight within the indice is greater than the other 495 other stocks within the indice. So it's kind of incredible. So, all right, guys, just wanted to give you that update. Again, if you have any questions, I'm going to add in that Excel sheet for you guys so you can have it. Use it, and if you have any questions on how to use it, maybe if you already have a portfolio and you wanna plug in your portfolio to see how much kind of dividend yield you're getting and whatever, you just ask away, and I would be happy to help you guys. All right, everybody, have a good night, take care, and I will talk to you next time. Bye-bye.